Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, New York Sweaty Edition. I am in Fairfield County, Connecticut today. Hopefully, the audio is a little bit better than it was on Monday, but we are still struggling a little bit with the HVAC here. So we've got through-wall air conditioning going in this room, and it's a little bit noisy. Hopefully, that's not too distracting. Okay. So before we get to your questions, one of the things that I was thinking about and that I thought we could discuss was how I like to think about identifying good covered calls to trade. So let's see here. I'm just going to also, we're having a little bit of a technical issue on the screen share front. I don't know where we're at on that. Hopefully we're going to have something in a second. All right. I think we're also getting some audio feedback. Again, appreciate your patience while we sort these things out. And now I'm hearing a whole lot of music. Okay, so yeah, looking at NVIDIA, which is of course hitting new all-time highs, I was giving a little bit of thought to valuation. If we look at NVIDIA simply on an earnings to growth basis, it is not unreasonably priced. Still see very nice bottom line growth. So those are all, good positives, and we don't necessarily have an issue with paying for growth when we get it. But it does occur to me that much of this growth is depending, among other things, on some extraordinary margins. Not that it hasn't been able to earn them. It has. They're in a singular position at the moment, and that justifies the prices. I mean, for as long as you can't keep up with demand, then you should price your goods presumably to whatever level the market will bear. They appear to be doing that. That also will provide additional capital for the needed investment to make sure that you can innovate and also build to the requisite level. And we're doing that. But the issue that I have is, at this point, we can't really anticipate that margins are going to continue to expand at the rate that they have done. I'm just going to take those ears out because I'm actually hearing myself when I do that. So the thing that I was thinking about is that if you happen to own the stock, and I recognize that a lot of you do already, maybe this wouldn't be a terrible time to consider writing some upside calls against it. Okay, I've just been advised that I can actually put my IFBs back in, so we're good. And how do we go about doing that, and why would we take a look at doing that now? So I have said on several occasions that I don't recommend selling covered calls going into events such as catalysts. Now, I happen to overhear a couple other industry folks talking about how they often don't like selling covered calls even a couple of weeks before an earnings event. And I wanted to talk a little bit about why that might be the case. It's probably not as true in the case of NVIDIA, but there are some elements here. One of the reasons for this is that there can be some information flow during earnings season in general that comes from related businesses and their operating results, and goes into the results of a given company. In the case of NVIDIA, I mean, one could argue that you're going to hear operating results from a number of other businesses, including those that have massive capex in the space, and that is going to serve as a reasonable input into one's assumptions about NVIDIA's continued growth rate. That said, they don't actually report until late August. I think it's August 27th or something. Let's just double check this. And then I just wanted to talk a little bit about, once you've done that, we'll take a look at the valuation. Yes, August 27th. Okay. So if we take a look now at the company's valuation, here are two metrics that I think are kind of interesting. And one of these is price to sales, the other is price to free cash flow. Why price to sales rather than price to earnings? Well, bear in mind that I was just talking about the fact that we are at record margins, right? So the forecast margins for the next fiscal year are roughly 56% net after tax, right? So that's the adjusted EPS estimate that the sell side has on average for the next fiscal year in terms of their net income margin. So if you're thinking, can those margins be preserved? Can the growth rate be preserved? Then you might start thinking a little bit about the price to sales. And so here I have a 10-year, this one down here, the light blue bars, this is price to sales. Is it as high as it has ever been? No. But is it towards the upper end and above average? Well, yes. So we're around 26 times. We can see here, if you look at where my cursor is down here, I'm going to blow that up just a little bit. The average is about 17 times. So it's at a meaningful premium. If we take a look at the price to free cash flow, here again, we're looking at, well, more recently, this hasn't been, there was periods when it was significantly higher, but we can see that before the most recent growth cycle, it was certainly a lower level than this. Okay, so let me get back to my other screen here if I can find it. Yes. All right, so what are we looking at over here? Some things to think about. We like to try to find a balance between time to expiration that gives us excess short gamma, this is basically what I've done here is I've filtered all the potential covered call sales that one could make. I looked for an annualized yield of 5% minimum. I'm going to address this a little bit more in just a second, just as an initial filter, and a minimum bid price of $1. This with the stock around, we'll call it $170, $160, $170. So at least 50 basis points at the stock price, and looking at any and all expirations. Now, those of you that follow Tony Batista and Tom Sosnoff will know that they often will advocate selling in the 7-8 week range, 45 days to expiration, covering them with 21 days to go. And the rationale for that is that you could potentially capitalize on a decline, in theory, in Vega. That's one potential benefit. You are still in a very steep part of the decay curve, but you don't have quite as much short gamma. So it's arguably a little bit more manageable. The other thing is that if you're trying to identify strikes that have low probabilities of assignment, you're going to be choosing strikes that are further away. So as the stock starts to move, you're going to have a little bit of time to work. Now, if you're also looking at a situation as we are here where earnings aren't coming right up, and why do we worry a little bit about earnings in terms of selling options premium? Because you have a bigger opportunity for price jumps. New information comes to the marketplace. Options models assume price continuity, meaning that there's basically, it's a process where we can sort of describe its movements in small periods and large periods by volatility. But of course that doesn't work when you have discrete events where new information comes out and the price is not continuous, meaning it doesn't move continuously from one price to another, but it actually experiences big price jumps. So if a stock goes from 100 to 110, instantly when earnings come out, that's what we would refer to as a price jump. Those also tend to become a little bit more difficult to manage. So as you take a look at my screen right here, I just wanted to give you guys a sense of what it is you're looking at, and also just so we can begin to see some of the trade-offs that occur between selling nearer dated options and the accelerated decay rate, the benefit of the accelerated rate of decay that those offer relative to longer dated ones. So if you notice here, the very first line is the July 25th, so 16 days to expiration, 172 and a half calls. Okay, I'm not necessarily recommending these as a sale, but we're just going to go over a couple things. Annualized yield, more than 17%. So here what you're doing is you're taking the amount of premium and you are essentially assuming that, a linear assumption and it's annualized. Now, when you see this yield rate number, what is the difference between the yield rate on this table? Maybe I can blow this up a little bit. Let me see if I can do that. So it's a little bit clearer. So the difference between the yield rate and the annual yield is related to all of this information over here, which is the probability that the stock does not actually get to this short strike price. So the annual yield is being discounted by that probability. So in this way, you can see, okay, here's what my standstill yield is, and here is more of a risk-adjusted yield. And so you will see that, of course, improving the annual yield helps, but it doesn't necessarily help quite as much as you might think. So, for example, as I go out to August 8th, 172.5 strike, this is the same strike option, okay? The annual yield bumps from 17.25% to 22 and almost 3/4%. Okay, but you'll notice that that's on an annualized basis, so on a standstill basis. But you'll notice that the yield rate is only marginally better, and that should make some intuitive sense to us. Why is that? Well, because the likelihood that the stock exceeds that 172.5 strike price over the course of the next 30 days, rather than over the course of the next 16 days, is going to be significantly higher. The other thing is that for those of you who own shares of NVIDIA and have held them for a lengthy period of time, capital appreciation has most certainly been your friend. This is an important component. Okay, so I'm being told you can't actually see my mouse, but I'm not exactly sure. Oh, you know what I can do? I can probably annotate now that I think about it. So let me do that. See if I can. If someone can just get in my ear and let me know whether this works. If I do this. All right, excellent. Because what I'm doing here now is just due to some technical difficulties. We're actually sharing my screen via Zoom at the moment. That seemed to be the best way to do it while we're working remotely on these laptops. Okay, so this is the section that I'm referring to here. Let me just clear this. I'm going to clear my drawings, and then we're just going to create some arrows and things so that you guys can see what it is that I'm talking about. Okay, so when I'm referring to the annualized yield, the standstill yield, that's this column right here. And when I'm talking about the probability adjusted yield, that's going to be the column right next to it right there. These color bars, as you would probably guess, indicate that statistically better risk-adjusted rates of return are going to be in dark green, and less favorable ones are going to be in either lighter green, pink, or red. So, red, as you can see here, this is less than the risk-free rate of return. Now, this is an incremental yield number in theory, so it's not necessarily terrible, but this is not the kind of yield that we would normally look to do. So if we're using then the approach that has been advocated by many to sort of focus on that, we're going to call it 6-7 week to expiration range, and you'd have plenty of time to cover these beforehand. You could look out to, for example, the August 15th expiration or the August 22nd expiration, both of which expire prior to the earnings announcement date on the 27th. And, these have decent incremental risk-adjusted yield rates, like the 175s here, 9.4%, perhaps 8.8% for these August 22nd. So again, I'm just going to do a quick annotation so we can see what I'm talking about. So right over here, this is the number we're paying attention to, the yield rate with the probability adjustment. I'm going to ignore, so here's the interesting thing. When these statistics are being calculated by the machines, they are not accounting for the event variance. So these numbers beyond August 27th are in the short term. These numbers here are all going to be overstated. And why is that? Because as you're calculating that yield between now and earnings on the 27th, September implied volatility is going to rise to incorporate the event variance. And so the rate of decay, let's just say that your hope would be that, okay, well, I'm going to cover these things after, call it 3 weeks or so, 3-4 weeks. Your rate of decay is actually not going to be that great because what's going to happen to those options is the implied volatility is going to be rising. So if you look at the theta of those options, it's going to be overstated. So really, this is going to be the area of focus for us. Prior, that means above this line. Okay, you're looking at options that expire before August 27th. Now, incidentally, if we want to, if any of you have questions or if any of you are engaged in covered calls, one of the things we can do is we can punch it into the same machine and see what kind of results we get. So I'm also going to have to double check here and just make sure that my tracker is working so I can actually see. Aha! There we go. All right. So we do have some questions. Good. So I assume that means that people can... Steve Garcia says, hello from sunny and warm Marin County. I had my cost basis automatically adjusted up today by a wash sale. Do you think the wash sale law is a good idea? I don't. Look, the way capital gains work, I really do have issues with this. And arguably the best example that I have about, and again, I'm not providing any tax advice. I encourage people to get their own tax advice. This is just my own personal opinion about things on capital gains. That is to say that, and Marin County, for what it's worth, is a very good example of this. If you bought a property in my neighborhood, there is the house right next door to us. I believe the prior owners bought it in the mid 70s or late 70s, 77, I think, if I remember what our neighbors told us right before she moved away a couple of years ago. I think she said she spent $30,000 for that house in 77. She sold it for $3 million. And they did nothing to that house, right? So it's a capital gain. The house is the same house on the same lot as it always was. It is unimproved. Arguably, one could say it was a bit dated and needed improvement to be as nice a house today as it was then when they bought it. So capital gains, in part, are just a tax on inflation. So the government can create inflation and then it can tax you on the inflation it created. To me, that's a little bit problematic. Another issue about capital gains tax that I find a bit problematic is that we want capital efficiency. We want money to flow where it's going to be put to the best use. And if taxes, just like tariffs, if tariffs can create restrictions and bottlenecks on trade or deterrence of any kind, that's not necessarily positive economically. So too is it true that anything that discourages people from doing what is arguably the best with their capital is not in everybody's best interest. And so you have a lot of perverse things going on. So my issue with the wash sale rule isn't so much about whether or not there should be rules to prevent those from essentially affecting transactions that allow them to circumnavigate tax law. We shouldn't have that kind of loophole, if you will. So once you've established that a tax law is appropriate, then I think it is similarly appropriate to establish that you should try to eliminate obvious loopholes that would get around it. But in this particular case, the bigger question is the efficacy and benefit of capital gains taxes. And when you consider that, the wealthiest folks are frequently able to avoid capital gains tax simply because they don't sell their assets, they borrow against their assets. I think the capital gains tax in general has a lot of flaws. So it just doesn't end up getting applied the way it should, and it impedes capital flows. There are plenty of issues with it that I'm not crazy about. So, but I'll let everybody else have their own opinions on that. I would also quickly say, Steve, that you're talking in this case about a warm and sunny Marin County. Well, let me tell you, it's not warm compared to where I am now. I think it was 95 degrees and quite humid here in the New York City area yesterday. And yeah, we don't get that living close to the bay. It's very sunny. In fact, it's sunnier more of the time. But 95 degrees, we don't see that. I'm sure there are parts of Marin where you do if you're more inland, further north than we are. But if you're close to the bay, 95 degrees and humid is just not something I'm very used to at this point. I should be. I've spent plenty of time out here, but something about living in California weather makes you soft. I guess I'm soft in that respect. Okay, let's see here. Yeah, so we're going to move away from the tax conversation, but I encourage you guys to discuss it to your heart's content in the live chat. I mean, it's an interesting topic. I am not a tax attorney, and I'm not an accountant. Obviously, I have my own views about whether these things are good, though. 78 and sunny, slight breeze. Yeah, that's apparently the weather in Marin right now. No clouds. That's also typical for this time of year. Perfect weather is what we usually get around now, all the way through September in the Bay Area. And I will be heading back there over the weekend. I have a NASDAQ closing bell ceremony on Friday, so if you happen to be watching CNBC, I don't actually know how many people are going to be down there when they ring the bell, but I'll be down there, and then I'll be on Fast Money for the full hour in the studio upstairs thereafter. Okay, so Alex V, what do we got here? So you are, I'm going to just, again, unfortunately, I normally, when we do this from my home office, I have 7 screens, and 4 or 5 of them are associated with the main machine that I'm sharing with you guys. Now I'm dealing with 2 laptops, so I hope you guys can forgive me of sort of fumbling my way around here. But I figured something was better than nothing. So we're doing the best we can. Okay, so you are looking at... Okay, well, let's have a look. You're looking at CoreWeave. And let's take a look. You have their earnings as August 14th. And did I share that? And just make sure I've got that on screen. So there's your question. How about CoreWeave as another AI play reporting on August 14th? Is that correct? It is, at least according to Bloomberg. To buy a call vertical 155.95, or would a risk reversal be better? Implied volatility 90%. Okay, so I think I've just one of the first things I'm going to discuss here is I think something I've mentioned in the past. Implied volatility, well, realized volatility and implied volatility for new issues in general does follow a pattern. There's a price discovery process that goes on after an IPO, and during that period, volatility tends to be quite elevated. And as time progresses, things normalize, and you will see both realized volatility and implied volatility come in, as you would expect, as it sort of finds its way, if you will. think I may have mentioned that I did quite a lot of this work ahead of the Facebook IPO, now known as Meta, because this was one of the biggest questions. They were doing a $15 billion offering. At the time, it was the largest, if not one of the largest anyway. There was tremendous amount of interest in both the stock, what people thought would happen, and of course, there was just a huge amount of options activity right out of the gate. And nowadays they issue options much more rapidly than they did then. As you can see here, the average 20-day volume for CoreWeave options is 400,000 contracts, give or take, almost. It's traded 756,000 today. So I think it does make some sense to sell some options as a part of your directional strategy, because especially after you get that earnings result, every new bit of information that comes out and every incremental month of time that the stock has to trade after its IPO, and the exception to this I would make is if you have a hard borrow or an impossible to borrow situation, that can be very different. So example would be something like GameStop. It was a hard to almost impossible to borrow stock. There was a big squeeze going on. When you have a situation like that, volatility can remain elevated for as long as that situation persists. But absent that, and actually let's just take a look. Why don't we just double check the short. It has a high short interest, but the squeeze risk is not necessarily considered to be great. So we can look at this S3 squeeze risk over here. So 31% of the float short is not insignificant. But then you have third parties that kind of monitor that to check. And by the way, you'd be able to tell this too simply by taking a look at the forward. Remember what I don't think I talked about this on Monday, but I certainly have within the last couple of weeks. What is the forward? Take a given expiration, look at, say, the at-the-money strikes, take the call price plus the strike minus the put strike, and that number compared to the stock price will give you some sense. If it is well under the current stock price, that means that there's probably a high cost to borrow the shares, which means it's a hard or impossible borrow. Most likely a hard borrow, because if it was impossible, you'd probably know that already. And the normal condition would be for stocks that don't pay dividends, which most stocks that recently IPO'd do not, is that the forward, that is the call plus the strike minus the put, all same expiration, same strike, that number would normally be is going to be a little bit higher than the prevailing stock price by about the risk-free rate of interest, right? So if you take a 5% interest rate and you're looking at options that expire 6 months from now, and it's a $100 stock, then you'd kind of expect the forward to be $102.50, right? So half of the risk-free rate of return over above the current stock price, assuming that there's no dividends and there's nothing funky going on. If the forward was trading $95 and the spot was 100, then you would know that there was a cost to borrow the stock, and that would be embedded into the forward. So if the synthetic stock is trading at a big discount to the price of the stock right now, then you know that there's the stock's probably hard to borrow. Again, assuming no dividends, all that kind of stuff. Okay. So what I would think then would be that something like a call spread could make some sense. Now, a call spread risk reversal, I think I've pointed this out before. A call spread risk reversal, you're short more options than you're long. And it's a little bit like selling puts, but you're squeezing the balloon a little bit so that you don't have any immediate risk to the downside, and you get immediate participation to the upside. The upside is capped, and then your downside risk is, the risk of being short a put. And if I'm not crazy about doing buy rights going into earnings, then I wouldn't normally be crazy about a call spread risk reversal either, because it has very similar characteristics, unless I'm giving myself a really, really nice border, of protection around it. So let's just take a look at CoreWeave and see what that looks like, and then compare the call spread to, let me see, can I move this thing out of the way? I don't want that there. All right. Okay, so first of all, we'll just take a look at a call spread. If we're just going to target the event, maybe you could just look to something that expires just after. So this is a week, this is one day after. Reports on the 14th, these expire on the 15th. So this is basically just targeting the specific event. You like the stock. I don't know that it necessarily has to be in the money. You could probably pick something slightly out of the money. This option here at $1.22 is almost not worth selling against this, so I would probably reduce that to a slightly lower strike. Maybe we can go over here, for example. I'll go to 2. Yeah, that's fine, actually. Let's see what this looks like, just for giggles. Okay. So now you're looking at a $50 call spread, less than $8. That seems like a reasonable risk-reward relationship. It's less than $8 and it's $3 in the money already. So I think that's okay. Because the implied volatility is so high and because I think it's going to continue to come in because we're just coming off of that IPO, it's probably not going to be terrible to do a call spread risk reversal, but I just want you to bear in mind what I was talking about, that it does have the element, you're short more options than you're long, so your downside risk is going to be a little bit more material. In this case, because I'm also thinking about a little bit more of a vol crush that I'd want to take advantage of post-event, I'm actually going to push the expiration out a little bit. I mean, we have some time, obviously, this being a mid-August report date. So why don't we use the same kind of approach? I'll actually use the same call spread strikes. So this actually doesn't even cost that much more. It's just $8 and change, which means I just have to find a downside put to sell. It's going to offset that. There we go. So now the 100, 150, 200 call spread risky gives you a slight standstill. You'll benefit from a vol crush. Risk is you get the stock put to you at 100, which may seem like a pretty good discount to the prevailing stock price, and it is because it's $153. You're actually collecting $1.90, so the effective purchase price would be closer to $98. But don't forget that this stock was in the 40s only 2 months ago. So, I think you could do that simply because the vol is still very high, and because I think that trend that I was talking about, that post-IPO trend, is going to come back. I mean, it has a lower risk than buying the stock here. It depends how much upside you think they potentially have. And to that end, why don't we just quickly take a look at CoreWeave's, what the street is looking for from CoreWeave. And, this is really the numbers that I'm going to put this into quarters because we don't have much of an operating history here. But the expectation is for $100 million of incremental revenue. So $100 million worth of revenue growth, more than 10% revenue growth quarter on quarter. And then an even larger sequential growth is anticipated, which you probably will be able to get some insight into on their call. So almost another $200 million of incremental quarter-on-quarter revenue growth. So these are big numbers. These are high targets to hit, but believable. And yeah, so I think either of those two trades is probably fine. This is not Procter & Gamble though, yeah? You're 100% in the deep end of the pool with something that has a 90 vol. Okay, here, let's see what else we've got here. More questions on the trader tax status and stuff like that, so we're going to leave that. I see Kirk was asking. Yeah, we were having, as you all probably were able to gather in the beginning, we were having a little bit of technical difficulties here. You can see we've made a slightly different arrangement. Normally you don't see a microphone in frame, but I'm hoping that that improved the audio quality just a little bit. You guys can comment on that and let me know whether it's true or not. Eileen, I've made some bad calls in healthcare lately. The most recent is CNC. I'm thinking it can't get worse, but would love your thoughts. Yeah, this has been a really tough one. Well, I think the toughest by far in healthcare has been United Health. And one of the things I think that's interesting in this area is that I don't think I would have anticipated what we got in United Health after just so many years of exceptional operating history. Now you have the government investigating whether there were any improprieties. That's just total game changer, right? So as far as that goes, I would certainly say that this is the worst one I can think of. It's had one of the largest wipeouts in terms of market capitalization of a previously phenomenal performer. And I've mentioned this stock many times because a former colleague of mine worked for the company, and I worked at CRT Capital, our head of research. Cheryl Skolnick ended up going to work for the company for a number of years, and she loved the business for many years prior to her going to join that company. It was one of her top picks in the period basically from, I'm going to say it was probably, when I was at CRT, when was that? 2012 to 2014-ish. As you can see, not a terrible time, and she was right about it then, and for many, many years thereafter. But there have been a whole bunch of things that are so. Number one, we have obviously the regulatory overhang and DOJ stuff for United Health. It compromises the entire space, even companies that weren't necessarily directly involved, competitors like Humana. So that has certainly been an issue as well. And then, of course, one of the problems is that you can get some carry-on effects that take place. And what I mean by that is, let's just say that people were investing in XLV, which is the healthcare ETF. And now, all of a sudden, something like that starts getting hit because one of its largest constituents, as we can see here, United Health, and it was a bigger constituent before it shrank as much as it has lately, starts getting hit. Some Lilly, which obviously has a great story, but was kind of rolling over as a result, it ends up creating flow out of the space. And as money flows out of the space, it's even going to hit companies that aren't necessarily facing the same challenges. What was Lilly's challenge? Well, it's not an operational challenge. They have the best of the obesity drugs. So that's a big positive. The problem was that it went from a very low multiple non-growth stock to a very heady multiple, and it just gave a significant amount of that back. Then, United Health obviously has its own problems. So in the case of CNC, from an operating basis, we can take a look. And, right here we have the top line. You can see that it sort of meets our core criteria in this respect. Still growing, all good. Expectations are for, significant free cash flow in the future, although it wasn't necessarily experiencing it last year. But even at this number here, $1.5 billion in free cash flow over the last 12 months is a very comfortable free cash flow yield. So we like that. We're looking at adjusted EPS growth of better than 6% year on year for next year, more than 5% for this year. These are solid numbers. If these free cash flow numbers down here, if you're looking at the lower left of my screen, you're going to be seeing 3.6 to 3.7 billion. Well, if that's real, and the stock's price is not reflecting that it is, but if that's real, I mean, this thing is epically cheap. Where do you buy companies where you're getting 20% free cash flow yields? You don't, right? So the price is telling us something doesn't jive with respect to how the stock is priced and what the sell side is expecting in terms of the company's future. So now the question for everybody to ask themselves is, okay, am I going to just simply believe the price action? Am I going to believe what the analysts think the growth trajectory of the company is going to be? Or am I going to kind of split the difference? You know, my inclination would be to say, now here's the problem. This is definitely catching the falling knife, something not normally totally crazy about, because that usually is a sign that there's something very significant wrong. But the truth is, you have a situation here where, you're getting this thing at a very cheap valuation at its current price relative to street expectations, which means that a hell of a lot of bad news is priced in. You can add to that, this is the implied volatility and the realized volatility. Of course, the realized volatility is off the chart because we got that discontinuous pricing. Remember what I was talking about at the very outset? Price jumps. You had that huge price jump, as we saw. In this case, it wasn't a price jump. It was a price jump down. Price off a cliff kind of thing. But that does suggest to me that, one could contemplate, a partial position, possibly supported with some short premium around it. Let's take a look at that, actually. Now, if this was a stock that you have bought before the big price drop that it experienced recently, a stock recovery strategy is going to be pretty tough when you get a gap that size. So let's just talk about that first for those who don't know what a stock recovery strategy is. So let's just say that you own 100 shares, but in the case of Centene, you didn't own it at $33 a share. You owned it at its pre-crash price. So it was trading around $55. Let's just say you bought it sometime in May and you paid $60 a share for it. Okay, so the stock at this point is down, it's almost been cut in half. So one strategy that a lot of people will do as a stock recovery strategy in a situation like this, they don't want to deploy new capital to the stock. So they don't want to buy more shares because if they thought it was cheap at 60, it's much cheaper at 33. But they don't want to, throw good money after bad. The other thing that they'll recognize is that, where there was support, that becomes resistance. So that's just sort of a general technical saw. But there is a real logic to it, which is that anybody who bought it in and around this price up here is going to have a real interest potentially in selling it, having, touched the stove, been burned. They don't like the stock anymore, but they're stuck in it because they don't want to sell it at a loss. If they have an opportunity to get their money back, very often they'll just take the money and run and try to put it in the rearview mirror. And what that means is that there's a significant amount of overhead supply because anybody who traded the stock on the buy side for ages has a much higher cost basis than the current level. So what some will do as a recovery strategy is they will hang on to the stock, but then what they'll do is they'll add a 1-by-2 call spread against it. And the logic of this is, so we'll just say, and they'll try to do this at, like I said, they don't want to throw good money after bad. So generally speaking, what they're going to end up doing here, let's just advance this a little bit. Let's go out to September. So maybe you buy the 35 calls here, and then they look to sell something that is, two of those at something close to that price. Now this is a little bit worse than that. This should be a sell. Okay. So this is actually not collecting. You actually would be committing a little bit of additional capital on this, but not that much. And essentially what this does is it boosts the returns that you experience on the near upside because you're long that 35 strike call. You haven't really spent a great deal of premium because you've offset it by the sale of these 2 upside calls. And effectively, you will only have been worse off for having done this trade if the stock gets through sort of the break even of the 1/2 call spread on its own, which is going to be up near, if you're able to put it on for something close to even, that's going to be around $45 a share, which is significant price appreciation from here. Anything in the middle, and you're better off for having done this. And these are called stock recovery strategies. Now, one of the things I had said right before we got into this was I said, when you have a decline as sharp as this one is, oftentimes you're going to see with these stock recovery plays that they really can't help you out that much because the gap down was so severe that you end up having a break point that's well below where the stock was prior. Still, I don't know that this is necessarily a bad strategy. And the reason I say that is because we only trade from settlement. And what I mean by that is that once new information has come to the marketplace, where the stock was before doesn't necessarily have that much bearing. You know, what you have to trade the hand you're given, not the one you wish you had. So that's one thing that you could think about doing. And again, Eileen, I know you already have a position in CNC, but for others who are now looking at this saying, oh, I didn't look at Centene, I didn't realize that it had such a gap down. Maybe it's becoming interesting to me here. Another possibility would be to do a half position on the long side in the stock and maybe sell a little bit of, because you're getting this, the big spike in implied volatility actually has sort of come and gone. That previous chart, I don't know if you guys remember what you saw, but after the gap, the implied vol shot up and then it sort of came back in a little bit. Nevertheless, we're going to look at this way. So what you can do is you can also sell strangles against a partial position that you would otherwise be interested in potentially adding to. So what are we doing here, and what's the logic? Well, the upside call, and look, a short put and a covered call are kind of synthetic equivalents, so you could also think about it as a laddered cash covered put, or as a buy right or covered calls with 2 different strikes. It's effectively the same thing. But the logic is if you have no position and you add half of a position, so let's say you allocate anywhere from 2 to 5% of your portfolio to your single stock bets, then you could allocate 2.5% to a position in this thing, and then sell a downside put where you'd be willing to get in a little bit more and sell the upside call. And what's interesting about this is that now you're kind of collecting some premium. And you're going to collect the premium on both sides. So in this case, it's going to be almost $1.90 over the $33 stock price. So, better than 5% over the course of mere 6 weeks or so. So that's something else you could possibly consider. And Eileen, yeah, I feel your pain. It's not like I haven't made some badly timed calls before. I think we've all done that. Usually for me, I have to say, is that it's in a situation a little bit like this where I'll see a stock that maybe I hadn't been paying that much attention to. It comes in and think, oh, well, this, now's my opportunity to grab this thing on the cheap. And, one of the things that we have here is, at the very least, we have a catalyst. So, the stock was weak going into it, far weaker than the market overall. As you can see here, late 2024, the stock was it's actually north of $80. And more recently, the thing was already down quite a lot. The big difference is that now we kind of know what the story is, right? So this was the story. You guys can find this. If you just Google Centene sinks most in 19 years after pulling guidance, you'll probably be able to find this story. I mean, I'm sure most of you don't have a Bloomberg terminal, but most of these stories are also published elsewhere. So my guess is that you'll be able to get this. So, and that, by the way, for those of you who weren't, following the story, that's the reason why the why the stock dropped. It's because they withdrew guidance. And that's rarely a good thing. I think we can admit that. And if they're withdrawing guidance, we can also assume that these numbers that I was showing here before, these were all based on the sell side's estimates, and their estimates are generally going to be guided by what they're hearing from corporate management. So I think we can reasonably expect that some of these numbers are going to come in. But they could come in a ton, and the company would still, in fairness, be reasonably priced. I mean, if they made half, if their adjusted EPS for 2026 is half what the street is expecting on what I'm assuming is already somewhat lowered numbers, but probably people are still reworking some because it takes some time and to get the stuff out there. That still has the company trading at about 9 times forward. So not terrible. I would worry about other things around that are hairier than lower EPS, though, because let's see, when did the company last make that little? So that you have to go back to between the 2018 and 2019 timeframe, a period when the company had less than half their current revenues, to see adjusted EPS in that area. Even back then, you're talking about $750 million of free cash flow, which wouldn't make it cheap with a $30 billion enterprise value, but it's not there now because it's much lower, 5% free cash flow yield based on 2018, 2019 free cash. I don't know. That seems okay. So, I'm not going to say it's not risky because, like I said, the company's withdrawn guidance. That's not a good thing. If it's not because they're going to come out and surprise you with good news. Let's put it like that. That's not the way that. It's not the way that typically works. Okay. Oh, you know what I would say? Let's leave Centene and United Health and Humana and all of those companies and Lilly, frankly, out of it for just a moment. And let's just talk more generally about the space. Because another thing that folks could certainly contemplate without making single stock bets is, doing something similar in XLV. So you're making a more general investment in this sector, understanding that it's been underperforming for a time, and that's not an idea I dislike. So that would be another way to sort of dip your toe into an underperforming sector that has historically actually been a safe haven without taking single stock exposure risk. In other words, deciding that you're going to commit 2% of your portfolio to a company that is not providing guidance anymore. And there are plenty of companies that don't provide guidance. It's a lot scarier when companies that previously did suddenly will not continue to do it. That's not usually a big positive. And like I said, United Health is now the 4th largest constituent of this sector. So this is the healthcare select sector index. That's what XLV is going to track. But let's see. Lilly. There's a lot of good stuff in here too, and if there's some form of a rotation, then this could be a decent place to get it. So a diversified basket, XLB, that's probably not a bad play. Also, for those of you who are not interested in saying, I'm not going to be the first one into the dark cave where management won't tell us what's actually going on. I have no light, and just take my chances that there's no bear in there. Then you can say, okay, you know what, I'll buy XLV instead. Not as much of an upside risk, but significantly less downside. PC says, Mike, you missed my question sent at the outset. I am going to look for it. Oh, wow, yeah, how did I miss that? Sorry about that. That had already filtered down to the bottom. So PC says, Mike, your view on short 45 day to expiration 20 delta strangle as time decay trade on stock, not averse to owning it, okay, but closing by 20 days to expiration and rolling out, adding a long 90 day to expiration call to it. Okay. No, I like that. I mean, you can go a little bit further out. I will say that actually I've talked about strategies like this before. So we could call those diagonal call spread risk reversals, for example. Do you have a stock in mind in particular that you want me to look at, or should we just choose a generic one? Let me know. Let's look at Schlumberger because I talked about Schlumberger on Monday. And it's got a decent, it has enough implied volatility to sort of keep things interesting. So we'll talk about that. Amazon, okay. Better to talk about Amazon. It's probably more broadly held anyway. All right, so first let's structure this the way you were talking about it. So you were looking at owning a 90-day call. There is no 90-day call exactly, so I'm going to pick a 100-day call. Why don't we choose stock close today at 222? Why don't we pick, something close to a 50 delta option? So the October 225s. We'll take that on the long side. Now we're going to add a short strangle to it. You have selected, in your case, you're looking at, call it 45-day 20 deltas. So 60% probability of assignment, at least as the market implies it. 20 delta strangle, if it's all right with you, rather than increase the probability of assignment. So the probability of assignment is less of an issue, and certainly it is on the upside if you are already long a call. So I'll take these for now, and then we're going to play it both ways so you can sort of get a sense of it. Short the 22, and there's another reason I'm doing this, so we're going to go short a 22 delta strangle now, because I don't have a 20 delta strangle exactly at 44 days. So this is if you sell a 22 delta strangle. In this case, you are buying the 225 calls that expire in October and selling the 205, 245 strangle against it. Almost 20% away from the current stock price, a little bit less. I think this is a decent strategy. You get a standstill rate of return. There is, you have a couple little bits of potential. So we've got the prime days are going on right now. Was today the first prime day? Can someone get my ear and just let me know? I think today was the first prime day, or was it yesterday? So it'll be interesting to see how the prime day sales go. But yeah, I think this is a fine strategy. Some people will call things like this poor man's covered call. I don't necessarily think it's a poor man's covered call. Sometimes it could be the smart man's covered call, depending. Smart man, smart woman, smart whatever. If the strangles make good sense, because you do, again, get a standstill rate of return, you increase your probability of profit, and you decrease your worst case loss. Now, I would say that in this particular case, not a terrible thing to contemplate bumping it out to this 17 delta here. So now you're looking at a 200, 225, 250. And not just because that makes the math nice and easy for us to work out, because everything is, in fact, almost exactly 10% away, so you get the 10% worth of upside. Doesn't work out quite that way because not all the options expire on the same day. But so again, you're collecting less premium, so that's going to slightly reduce your probability to profit because it notches the break-even up a little bit higher. So when you bring those things in, caps how much you can possibly make, but improves your probability of profit because your standstill is going to improve. And actually, if you push those things far out enough, really what you're doing is maybe only offsetting the decay of that longer dated option, because that's there's a little bit of a trade-off that you're going to have there. But I like those trades. I do use them. Yeah, and you can manage around that. So I think that's a fine strategy. I'm glad, by the way, that you pointed it out, that I missed that question, because I should have gotten to that straight away. And we've already chewed up the full hour. No small portion of which was probably me fumbling around with these laptops and things like that. But I hope we did well enough while we're on the road. This is actually going to be the last time for a little while that I do the open mic from this location, because I'm actually going to be in the city for some meetings and things like that for the next couple of days. And then I have to go out to Las Vegas early next week before I go back to the Bay Area thereafter. That too may create some wrinkles with the live stream. Hopefully not too much. I'm going to try to do it, but if you just stay posted, look for the notifications. If for whatever reason I can't do it on Monday, that's probably because I had an issue with my flights, and I'm between airports or something like that, and won't be able to do the open mic in that particular instance. But hopefully save your questions, and if that happens, and I will answer them when we do return. So in the meantime, I hope you guys trade well this week, and I appreciate you putting up with the technical difficulties that we may have encountered as we take this show on the road, so to speak, and appreciate your time and attention. Thanks for watching.